Silver is doing something most people do not fully understand yet. The price just broke every record in history at $58.55 as of December 8th. But that's not the real story. The real story is that the physical market is breaking while the paper market is still pretending nothing is wrong. Welcome to 1% BTC, and today we are breaking down the case for silver. Our aim is to give you a fair, balanced, data-driven reason why you may want to consider investing in silver. I'm hoping to make this the one-stop shop for the only video that you need to watch at the moment, summarizing the bullish case for silver. As always, we are not financial advisors. Nothing in these videos should be considered financial, investment, tax, or legal advice. Investing in all things is risky, and you should take the time to do your own research before investing and consulting a fiduciary if needed. We try our best to provide a balanced view, but obviously our models, our data may be wrong or outdated. So David, you're going to be my test guinea pig for today, because as you probably know, I've been bullish silver for years. I've been investing in it for a number of years, and it seems to me like things are coming to a peak. But I know my impression or understanding, correct me if I'm wrong, is that you don't currently invest in silver.
Yeah, well, I'm really excited about today's video because I was a big gold bug and I switched to silver. This was about probably 12 years ago. This is when the price of silver reached all-time highs at the time, and everyone was piling into gold. You saw the shops opening up saying, "We buy gold and silver," right, on the high street. And it got me very interested, and I studied a great deal. I went head in on, but I currently do not invest in silver at all. This is probably about 7 years ago when I discovered Bitcoin. So I'm really interested to hear what your bullish case is for investing in silver.
Okay. Yeah. Well, thanks for that, David. And I like the fact that you admit that you don't currently hold any, and you've obviously switched your thesis. Obviously, just for our audience, silver has historically been treated as a form of hard money, and therefore it has a lot of similarities with gold and Bitcoin. Now, its hardness qualities obviously aren't as strong as either Bitcoins or golds. It's easier, there's more of it. Its half-life is a lot shorter than gold's. It's less durable, it tarnishes. But, and even though we've moved away from specific forms of hard money and we've moved to fiat money, I believe the bullish case for silver is still there. So let's jump into it. So the very first thing, and David, I know you know this well, historically, the gold to silver ratio has averaged around 15 to 1, which reflecting silver's role as poor man's gold with similar monetary value, but greater industrial utility. So by that, I mean that the gold to silver ratio, it basically means that for every ounce of gold that you can buy, you could used to be able to buy 15 ounces of silver. Now today it's elevated at 72 to 1. Yeah, and it was higher as of last week. So this signals that silver is undervalued relative to gold based on this classic average of 15 to 1. Yeah, so this is a classic buy signal as the ratio compresses. Just to put it in perspective, it did hit 104 to 1, as low as 104 to 1 earlier in 2025. Now, as you can probably tell by what's on the screen, this divergence often precedes silver rallies of between 40 to 400%. And here's the important thing, before reverting towards norms. So you tend to get these historic blow-off tops where there are supply squeezes within silver, or suddenly instant like increased demand for silver, but it does tend to revert quickly after that supply catches up to the demand, or the demand starts to slow. Now, adding fuel to this, the paper to physical claims ratio on the COMEX is, which is the primary US futures exchange for commodities like silver, is currently estimated at around 2.5 to 1. Yeah, so this is up from 1.6 to 1 earlier in the year. Now, when we say paper to physical claims, that means that there's 2.5 claims per real ounce. So it's a fractional reserve system on steroids. So it's vulnerable to a run on the vaults if delivery demand spikes. So you may have heard that expression, run of the bank. Well, obviously that it's because banks only have to hold a certain percentage of the money that they owe you on their balance in their reserves. So I think it's a few percent. It's definitely higher after the great financial crisis. But but obviously when there's a bank run, it's because people get concerned that the banks don't have their money and they rush to get it out. Well, the same thing could happen with silver, because obviously there's arguably not enough silver to meet the demand for it.
So currently, Dom, banks need to kind of store in their vaults physical silver, but as you say, there's an allowance for fractional reserve, I guess, lending or holding. So okay,
well, that's exactly right. And to put that in context, as you can see on the screen, 98% of contracts currently settle in cash. So when you trade silver, buy it, sell it, etc., it's not like physical silver is moving from one country to another or from one trader to another. Essentially, 98% of those contracts just settle in cash. They're settled digitally. But with these physical shortages, from what I can tell, even 5 to 10% standing for delivery could empty the registered stocks of around 73 million ounces.
That's crazy. And then that's been a big reason why I haven't why I switched out of silver and into Bitcoin, is because I wasn't certain about the auditing of the vaults and the supply that currently exists.
That's it. And obviously, with everything on Bitcoin being on chain and publicly visible on a publicly visible ledger, it's far superior. And the chances of there being paper Bitcoin are less than obviously paper gold and silver. Not to say it can't and doesn't happen. I'm sure it does already, but obviously the probability, it's far harder to do, is the point. Now, what's interesting is David's old friend JP Morgan appears to have been hoarding in record amounts. So now they hold over 160 ounces in their COMEX vaults. Now, to put it another way, they control around 50% of the deliverable supply of bars. Now, this obviously is going to amplify any supply squeeze. Now, JP Morgan, for those of you that don't know, in case you haven't heard the way that David and I talk about them in a very loving way, JP Morgan is one of the biggest and largest investment banks on the planet with deep ties to global commodities trading. Now, what does this mean? This means, as I see it, and this is just a prediction, all predictions are right until proven wrong. But from what I can see, if the ratio drops to around 50 to 1 for the gold silver ratio, silver could hit around $84 an ounce. Yeah. So, but a full reversion to 15 to 1 would mean that we could reach a price of around $280 an ounce. So there is a lot on the table, but this is just one metric. So I'm going to go into a few other things. Now, first, let's look at our old friend JP Morgan. Industry data does confirm that JP Morgan accumulated silver aggressively since 2011. Some analysts, and there's really mixed reports, estimate that up to 675 million ounces total is now controlled by JP Morgan. That's across COMEX, London, and over the counter. So silver they bought directly from arguably people, other traders, people like you and me. So to put it another way, that's around 45% of the world's above ground supply of 1,000 ounce bars, as I alluded to on the last slide. Now, the popular opinion that you hear from TradFi over the past 50 years is that silver doesn't matter. It's like gold. It's a pet rock. It's a barbarous relic. But the question I want to ask is, why would the world's biggest bank in America hoard almost half of it? If silver doesn't matter, why would JP Morgan suddenly commence discussing the debasement trade, which they've now tried to coin that phrase 6 weeks ago? So, David, do you want to just quickly tell us in 1 or 2 sentences what the debasement trade is?
Yeah, well, can I just really quickly go back to the origin, the history of JP Morgan, as to why they're now the largest holder of physical gold in the world, is because it dates back to the financial crisis. So they inherited massive silver positions back in 2008 because they took over and inherited Bear Stearns during its collapse,
Right. I
right?
didn't know
So it's quite interesting because that's, as you say, in 2011, that's where they then started adding to that really strong position. But I think they say that it's estimated that they have between 600 and 900 million ounces, which is just astronomical.
It is. It's absolutely. And as I said, even though JP Morgan, well, JP Morgan, I haven't said this, but JP Morgan have actually been fined for manipulating precious metals markets in the past. Now, the fines that they paid have been a fraction of the money that they've made as a result. This isn't speculation. This is actual facts. Criminal charges have been brought and successfully applied against them. So we know that JP Morgan does have, as David says, a long history with precious metals and silver. And there have been elements of JP Morgan that have behaved in a nefarious way in the past. One thing I would say to your point, David, which I found interesting just about that, about the Bear Stearns, is go and Google at some point, all of our viewers, go and Google the price charts, the share price of JP Morgan, and compare it over the past 15 years and compare it to the other big banks in America, and specifically look at post 2008. And one thing stands out compared to, say, Bank of America and the other big players like that. JP Morgan has just become monstrous in size, absolutely monstrous. They've been on a almost non-stop run since that. I don't have the exact figures in front of me, but go look them up.
Interesting. Well, you know, JP Morgan is a great example of do as I say, not as I do. And I don't trust them because, you know what, they've been fined close to $1 billion in penalties, right? For their kind of the largest market manipulation fine in the history of precious metals trading. So it's crazy what they're doing in the background with gold and silver.
Gold, silver, and arguably Bitcoin, as we discussed. They launched the whole time they've been notoriously against Bitcoin, and then within the past couple of weeks, they've suddenly revealed their structured note with 1.5x upside, as we discussed in our a previous video. So yeah, completely agree. It's do not trust that the big players have your interest at heart, your best interest at heart. Investing is a competitive game, and it requires you to understand the game you are playing and to understand the rules of the game. And in JP Morgan's case, understand how they can be broken. But anyway, let's talk about supply and demand. Obviously, we've touched on supply and demand, but what does it really mean? Now, silver has reportedly been in a structural deficit for 5 years in a row. From what I can see, the deficit is pretty large. So there is just more demand than supply. Now, industrial demand is the biggest for that. It now accounts for 59% of all consumption. Now, the reason for that is obviously solar, EVs, 5G, AI, medical, data centers. Silver is used in most electronics. And the trouble is that the supply just isn't catching up with that. The mine production, to the amount that mines produce, is actually down 7% since 2016, with projected at just 835 million ounces for 2025, which is nowhere near the over 1,000 million ounces required in demand. So this is all amid a flat global output and a few new mines coming online. And just to put it in perspective, if you think this is a short-term thing, it's not quick to set up a mine. New mines take between 10 to 15 years to bring online. So if this is a squeeze, as I believe certain metrics are showing, it's not like it can be easily resolved if the demand doesn't slow. Let's take a look at those deficit projections. So there simply is not enough metal, at least that's what they're showing me. With vaults emptying, physical delivery times for silver bars and coins have ballooned from the usual 1 to 3 days to 2 to 4 weeks or more in key markets like London, New York, and this all comes from reputable sources. This data is from the LBMA and COMEX reports. Now, US dealers report backlogs of up to 300% year over year, forcing
Wow.
some buyers to airship metal via commercial flights. So imagine that. You've got to organize a commercial flight, just a normal, as you do, flight, to ship precious metals.
Think
Now,
of the security and the costs involved with that undertaking.
Now, to put that in perspective, this is not the first time it's been done, but it's a tactic once reserved for gold and only during crises. So I'm unaware whether this has happened before with silver, but what I'm saying is it's not regular. This is not normal to see. Now, in Shanghai, lead times for industrial grade silver hit 6 to 8 weeks in Q4 2025. Now, to put that in perspective, that's up from 1 week in 2024. So the refiners are prioritizing domestic needs, obviously in China. Now, this, how do I put it? This to me doesn't appear to be hiccups. It seems to be proof that the physical chain is snapping under deficit pressure. So it's pushing premiums higher and signaling an imminent supply squeeze, or at least for me. Now, what other evidence is this? Well, the evidence is that inventories are collapsing. The COMEX registered silver has fallen from 150 million ounces to 73 million ounces. That's a 51% drop. That's over 4 to 5 weeks. That's around 4 to 5 weeks of global industrial consumption. Now, the LBMA, the London Bullion Market Association, which is the global benchmark for precious metals trading, described this as the market as being in a state of seizure. And once again, going back to Shanghai, inventories are at 688 tons, the lowest in decades. So whether it's delivery, whether it's inventory, we're really starting to see signs that there just isn't enough silver. But what's the result? The result is that the metal cannot satisfy the demand if people ask for it. Which brings us to the interesting, sorry, go on.
So it just reminds me of the story of when France demanded its gold back from the United States because they're worried about the reserves, that they're not being enough, and that there's kind of claims on the physical gold. So this is back, I think, between 1965 and 1971. This is kind of the backdrop of the Bretton Woods system, and it seems like it's leading up to governments or investors saying, I want my, as you alluded to, it's a bank run on silver.
Physical silver. Well, I love the fact that you brought that up, because I didn't actually think of that comparison, but think about that. So when there was fear that the US was unable to satisfy its demand for physical gold from other countries, and the dollar being backed by gold, and saying your dollar is as good as gold and you can redeem it for physical dollars, that actually directly led us to coming off the gold standard and entering the fiat system that we are now in, which is a huge, probably the most significant event, arguably, of the past 100 years in terms of the impact to people's lives. So if that's what can happen as a result of gold supply shortages, physical shortages, I'm not saying this physical silver shortage will have the same impact. What I'm saying is there is meaningful data throughout history to show that supply squeezes in precious metals cause real, meaningful long-term impacts.
You're right.
So thanks for that comparison. I think it was a great comparison. So what other things should we look at? Is there any evidence that the paper market is breaking? Like, in other words, are they going to do a France and actually say, stop giving us the paper version, the US dollars in the case of when they came to reclaim their gold, and give us the actual physical? Now, COMEX open interest sits at around 250% of vaulted silver. To put that in other words, that means that 2.5 paper claims for every real ounce. And remember, historically, 98% of futures contracts never demand supply, but that appears to be changing now. People are requesting physical, and that's what we're seeing in all the other signs. So the system was only stable as long as nobody asked for their metal back.
Yeah.
But obviously, everything I'm trying to show you today is that there is a quote unquote bank run going on, and these are signs that whether it's retail, or maybe not so much retail yet, but definitely the big players, whether it's nation states or big banks, are after the physical and starting to lose faith in the paper versions.
So, you know,
Now,
France actually sent a battleship to New York to collect their gold. So
they did.
yeah, they did.
And the US was worried that other nations would repeat. I mean, if you've got a tier one nation, such as France, it most certainly was at the time, going to the lengths of sending a battleship into New York to basically say, give us our gold or else. I mean, what does that do to financial stability? What signal does that send to other players?
Well, that's exactly right. Because basically, following France's lead, you had West Germany, you had Belgium, you had Switzerland, the Netherlands, all redeeming their physical gold.
Absolutely, which obviously led Nixon to take the US off the gold standard, temporarily, quote unquote, and that temporary was lasted over 50 years.
Temporarily, so there was a bank run on gold back then.
There was. So this stuff does happen. Now, the CME, in terms of what recent news events, so trading broke, in my opinion, on November 27th. At the very least, what happened wasn't normal. So the CME halted silver trading for 11 whole hours. Think of that. One of the biggest exchanges on the planet for precious metals trading halted trading for 11 hours. Yeah. Amazing. Now, they blamed it as a cooling failure. But here's the thing. During the outage, silver spiked to $56 an ounce. And secondly, the bid-ask spread, so the difference between buyers and sellers, hit $1. Now, the translation is liquidity vanished.
Yeah.
So this is what a short squeeze in the paper market looks like before it becomes a physical squeeze. This, to me, is a big warning sign. If you're worried that you're going to lose control of a certain aspect of the financial system, one way to do it is to just halt trading. Not to turn this back to Bitcoin, but we've seen it before. When the price of Bitcoin has run up before in, say, 2021, you've seen major exchanges mysteriously come down with outages.
Yes.
And you're unable to trade, especially when the price has been running up. Coinbase specifically has had multiple outages. I even think it's had a couple this year as the price was going up to new all-time highs. So this isn't just limited to the metals exchanges, not just the CME. And I'm not saying that the CME did this deliberately and it was nothing but a cooling failure. What I'm saying is it's highly coincidental, and what we can see is that bid-ask spreads hit $1, not normal, and we can see the price of silver spiked, not normal. And that, to me, does indicate liquidity vanishing.
Yeah, agreed.
So covering off, we say we always give you more information than you need. I've given you 2 slides of the same thing, but anyway. So what other evidence do we have? Well, we have evidence. Obviously, we spoke about JP Morgan. We've got evidence that they're pulling the physical metal off the market. So JP Morgan moved 134 million ounces from registered to eligible. Now, that seems like a lot of jargon, but basically what registered means is available for delivery, and eligible means stored, but not deliverable. So these are huge, huge quantities of silver with a huge, significant dollar value that are basically being marked as, we've got it, but we can't deliver it to you. In other words, they removed 9% of the global deliverable supply right as demand exploded.
Right. Watch what they do, not what they say.
So to me, you don't do that unless you're bracing for something. Now, this could be market manipulation if you've got your conspiracy theory hat on, but it could be them understanding that there is going to be a supply crunch and basically making sure that they've got hold of their silver. They don't want to give the physical stuff up, because why would you if you know that the demand for actual physical is going to spike and vastly outpace the price of paper? So multiple ways of looking at it. Now, another thing we can look at, silver lease rates. Now, basically, a silver lease rate is the cost to borrow the metal. Now, this surged to what I've called credit card levels. Yeah, meaning you only pay a mere 35% annualized to borrow silver. So that, I mean, even beats credit cards. So in other words, if you desperately need the metal you don't actually have, then you're going to pay 35% annualized to borrow it at the moment. Ridiculous.
That's crazy.
Yeah. Yeah. But let's go back to the demand. Is this going to get better anytime soon? Well, I touched on a few of these things earlier. Solar, EVs, grid upgrades, AI data centers, all of them require silver. Solar alone may consume, according to some analysts that I look at, between 300 million to 350 million ounces annually. So at the moment, as I said, there's only around 850 million ounces mined annually. So just the demand for solar, if it holds, may be around 300 to 350 million ounces. And don't forget, these are exponential technologies. As we move to a greener world, unless they plan to move away from that, as we continue to chase the AI arm or play in the AI arms race, the demand for silver in these areas is going to continue to increase. Now, as I've said, the supply side is pretty flat, and it takes 10 to 15 years to bring new silver mines on. So could this mean that we spike and then go down a bit and stabilize, but most certainly at a higher price? Yeah, I think so. Because the other things, sorry, go on, David.
No, please. Just a unique thing about this slide about the supply and demand pressures is currently gold is reused and recycled, right? Wherever, because of its value, it's such a high value right now. But with silver, it's not. It's thrown in the landmines, right? And they not landmines, the bin, the tips.
Well, it might as well be thrown in the landmines. I mean, if it's not, a lot of the time it's not economically viable for them to recycle it in small quantities, because obviously in things like your phone or a laptop, it is in such small quantities, and the price hasn't spiked to a level where it's economical for them to recycle it.
Exactly.
An interesting point that obviously I've known for a while, I think you're aware of it, David, is that a lot of the silver supply is actually a byproduct of mining for other metals.
Yes.
So there are very few actual silver mines, and the majority of, well, a significant amount of silver, not the majority, a significant amount of silver actually just comes from mining these other metals, things like copper, yeah, or zinc. Yeah, and if they find silver, obviously they refine it and they capture it. But the other part is obviously the recycling for silver, from what I can tell, is increasing. So there is more recycling, and you can expect that to go up as the price goes up. But once again, the question I want our viewers and you to ask yourself, David, is it going to keep up with the demand? Because governments have legally mandated these build-outs for these AI data centers. And more importantly, what this is going to create, in my eyes, or what the AI race is already creating, and what we're seeing, is a sort of AI arms race. And in a bipolar world, you've got the China racing against India, racing against Russia, racing against the US, racing against the European Union. Well, actually, not the European Union. They're absolutely useless. And they're doing everything to stay out of the AI arms race, or at least put themselves at a bureaucratic disadvantage. But just my opinion. But my point is that silver demand is not discretionary anymore. So ask yourself, dear viewer, is it going to keep up with the demand? Because I think not. So there's another thing to actually prove the geopolitics that I alluded to on the last slide. Now, China has reportedly stopped supplying excess silver to Western markets. So new export controls and quotas on silver start January 1st, 2026. So China has basically supplied that surplus for years. Now they're keeping it themselves. Now think of that geopolitically. If you think that the COMEX, the LBMA, players like JP Morgan have suppressed the price of silver over the past 50 odd years, and now you know that they're unable to do it anymore, arguably, you're going to want to make sure that you hoard as much as possible. And so, yeah, they basically said, hey, we've been your surplus for years. we've supplied you with all this excess supply that we've got. We're not going to do that anymore come January 1st, 2026.
Interesting. Oh,
So a few more things. What it looks like, in my opinion, is stage 4 of a supply squeeze. Now you can see this in different types of assets, but essentially the first stage is suppression, which I believe we've been living through for a number of years. So paper sells, physical is ignored. Yeah, and you can see that 98% of all silver trading is settled in paper or digitally, not in the physical asset. Then stage 2 is expansionism. Leverage starts to grow because obviously they don't require the physical asset to underwrite those contracts, and deficits fall. So the difference between the demand and supply dynamics, which obviously I've spoken through. Now, eventually we reach a break. Physical demand hits a finite supply. And we're seeing that. We're seeing, as I said, the mines are flat. New mines, although they are coming online, takes a very long time. And we're seeing that demand spiking, which leads us into stage 4, which is the eruption phase, whereas the price disconnects from paper. And I think that is what we're seeing right now. Now, historically, there is some evidence of what happens in these times. Now, I want a bit of homework for you and for our viewers. I want you to go look at the price of oil during the 1970s, the price of wheat during the 1840s, and the price of palladium in 2020. But just to give you an indicator of why I'm asking you to look them up, in 2022, when there was a supply squeeze on nickel, you saw the price increase 5x in 48 hours. So I believe that silver appears to be entering stage 4 right now. But as I said, do not trust, verify. I'm just a guy on the internet.
that's really interesting, Dom. Just look at those those 4 instances in history where the price has just spiked uncontrollably.
Yeah. And that's all markets are for our viewers who are maybe new to investing or are thinking about investing. A market and investing is just thinking about supply and demand. Are others going to want what I have? Am I buying something which I think is going to hold its long-term value into the future because the underlying fundamentals for it are strong as compared to weak? Now, slight bit of bullishness. Yeah, and this is pure speculation. I will completely admit to that. But obviously, the urgency behind getting out this video was related to this. So the Fed meets tomorrow, and this could be the spark. And this is pure speculation. But markets are currently pricing in, if you go on Kalshi or other probability betting markets, an 89% probability of a rate cut. Now, that would probably be around 0.25% basis points. So 0.25%. But to put it simply, rate cuts mean a weaker dollar, which historically has been bullish for metals and for Bitcoin. Now, meanwhile, at the same time as this, ETFs have seen record inflows of 15.7 million ounces in November alone. So the world is waking up to it. Now, obviously, a lot of the big buyers of ETFs is retail. It is pension funds. So it could be that although the supply squeeze is on the physical side, obviously the paper side will still go up because there would be a bidding war. So whether it's retail suddenly understanding this debasement trade narrative pushed forward through JP Morgan that Bitcoiners and gold bugs have known for years, or whether it's big players getting in ahead of the game, we are seeing it even in the derivatives like ETFs. Now, those total ETF holdings now hold over 1.13 billion ounces, which is a record amount of holdings within ETFs. Now, to put it in perspective, silver in terms of price is up almost 100% this year. Yeah, the rise has been utterly dramatic, and it's the best since 1979. So to me, this doesn't signal retail mania. This is institutional positioning. These are big players making big moves.
Right. So gold is only appreciated by between 50 and 60% this year, right? Compared to 100% for silver.
Yeah, but bear in mind, silver is more volatile than gold. Yeah, because it has both an industrial use and a store of value usage. Whereas gold predominantly is 90% store of value and 10% utility. Yeah. Silver is the other way. Silver is actually around, I think it's 60 to 70% of its value is actually derived from industrial uses, and that will only continue to climb, I think. So some other indicators. So some little fact nuggets to start to round up. Now, for those of you that don't know, I almost did a video on this a couple of weeks ago because it struck me as something that was completely overlooked in the Bitcoin space, within the traditional investing space. But the Trump administration just added silver to the official US list of critical minerals on November 26, 2025. Now, this is the first time designation unlocking federal investments, streamlined permitting for domestic mines, and tax incentives to boost US production and cut reliance on foreign supplies. Now, what does that coincide with? Coincides with China saying we're not going to provide that surplus supply anymore. So you've got the US, the Trump administration, acknowledging silver is now critical to the US. So bear that in mind. This is not just the big banks. This is at a nation state level. Now, so as I said, it's not just symbolic. So it signals a national security priority, potentially sparking $1 billion in government stakes for miners and tariffs on imports, further obviously tightening the global availability. Now, there are some other red hot indicators, and we've kind of touched them slightly before, but I just want to draw them out in more specifics. So silver lease rates halved briefly to 14% before rebounding to 24% annualized. Now, that's still 20 times normal, which reflects obviously desperate borrowing amid refinery bottlenecks. The LBMA vaults are down 40% since 2021 to record lows. And interestingly, and this is one I really did a bit of research on, retail sentiment for the first time ever is spiking in terms on things like Google Trends, so what people are Googling, on things like words like the debasement trade and silver price and silver price prediction. Retail is coming back to the game after being told for years and years and years by their financial advisor, you don't need gold, you don't need silver. Search interest is spiking because generally, unfortunately, retail tends to chase price as opposed to institutional, which tends to position themselves before these price moves happen. So prices potentially could go parabolic to $70, and we're obviously very, very close to that already, if the Fed ignites more ETF flows. And I think based on the certainty of that with the 89% probability, I think the Fed will cut rates. And I think we will see a slight spike in silver. The question is that going to push us over? So if paper jumps, physical is going to explode. Yeah. So in 2020, the spot price of silver was $28. So that's the price you will pay if you just want to buy it and hold it, say, on the internet. You don't actually buy physical. But the price of physical coins was $45. So that's a 60% premium that they were paying during this time in 2020 to buy the actual physical metal. Now, that's what happens when the metal simply isn't available. Even now, premiums on popular 1 ounce coins are surging. So the most popular coin, the most sought after coin, is the American Silver Eagle. It's the US Mint's flagship bullion coin. Now, it trades today at $9 to $12 over spot. That's a 15 to 20% premium. Historically, American Eagles only trade $3 to $5, and that we've seen that as recently as early 2025. Same thing for the Australian kangaroos, which are the Perth Mint's iconic design, so Australian version of the American Silver Eagles. They fetch at the moment between $8 to $11 over spot, which is 14 to 19%, which generally, to put it in perspective, you pay a far, far higher premium for American Eagles because they're so recognizable worldwide. But you're starting to see even Australian kangaroos, Canadian maples, United Kingdom Britannias, the spot to metal difference, premium is exploding. Not exploding, it's increasing every day. Now, these gaps obviously reflect dealers rationing their supplies and delaying shipping. So to me, this isn't hype. This isn't hype. It's hard evidence of tightness. Now, in a full squeeze, you could expect 50 to 100% jumps in that premium. That would mean that $100 spot price, if we reached it in silver, if there is a real squeeze, could mean that to buy the physical stuff, you're paying $100 to $200 street value. That's a $50 to $100 premium. Sorry,
Wow.
50 to 100% premium on precious, on the actual physical. So yeah, these are all signs that are showing that there is the case for silver. So global visible stocks are at critical lows, and this to me is a ticking time bomb. Visible silver stockpiles worldwide now cover just 1.2 months of consumption, from what I can tell. Now, this is well below the 3 to 6 month buffer that is considered safe. Now, London's free float of silver has plunged 75% to 200 million ounces, while the COMEX coverage ratios hit 23%. Now, you may not know what that means, but all you need to know is it's not good. That's the lowest in 22 years. So a bit more than 5% of open interest, as I alluded to at the start. So a 5% increase in open interest, standing for delivery, could empty vaults entirely. So 5% increase in demand or more, from what I can tell, means that those vaults are empty. Translation: supply squeeze. Now, just to put it in perspective, I don't see this as speculation. Now, you can argue that it is. I don't. David and I always try to look at the facts, and this channel is dedicated to giving you the facts. But we see this as math, not speculation. Now, with recycling, flat and mine output capped at $835 million an ounce, the deficit to me doesn't seem temporary. It seems like the new normal. So what happens next? And this is where we're going to end things. Now, this is where some speculation does come in, but I've tried to use facts for it where possible. Now, Bank of America predicts that silver could reach $65 by mid-2026. UBS, $52 by the end of 2025. Now, the question is do these estimates seem low based on what we've seen? Yeah, 100%. And that's why many silver bulls believe that the price of silver is justified at around $78 an ounce just on the solar demand alone. So obviously I touched on the demand from solar representing arguably 300 to 350 million ounces of demand alone against 850 million ounces of supply. Arguably, that demand alone, according to many silver bulls, could means that the price of silver should be $75, $78 an ounce or more alone. So what happens if the full squeeze erupts? Well, to me, $100 plus silver is not off the table. Now, the reason I say $100 plus is because if you go back to the 1980s and you adjust the price during the silver spike there on an inflation adjusted basis, that is what the figure I get is over $100. But what should you do? Now, obviously, as I said, none of this is financial advice. David and I are just two guys on the internet who love investing. But ideally, the first thing that you want to do is research. Do not trust what I have said. Do not trust the facts that David has given you. Go and research them yourself. Come up with your own opinion. One of the things that advantages, if that seems too scary, that you have today is to literally go on ChatGPT. It will cost you $30 a month, or go download Grok, or go download Gemini, or maybe get the free versions of all of them. Yeah, and ask it simple questions. Maybe screenshot some of our slides. Maybe take the transcript from this and ask it to evaluate and see what it thinks. See if our argument stacks up. See if the facts are accurate. You have the information at your fingertips that premium hedge funds had over the past 50 years, with teams and teams working for them. We now have that at our fingertips. So do not trust, verify. Second thing I would do, I would consider that if you are going to invest in silver, I would always recommend that it's a long-term hold, and to stack the physical. Now, you should look to find a safe custodian to store them. Now, in terms of your approach, it's up to you. If you think that that a lump sum would be better and you've got a bit of cash, maybe consider a lump sum. If you don't have much cash on the side, possibly consider DCA. Now, the also thing for those that have done their research and are a bit more advanced, consider diversifying potentially into silver miners because obviously if there is a huge price increase in silver, it then becomes profitable for those silver miners to then go out, create new mines, search for new supply, increase their output. So obviously you could see the price of silver miners also go up. But obviously I would recommend that only advanced investors do that, consider that, because silver mining, gold mining is highly cutthroat. It's highly competitive. And what I've noticed, especially online, is that you will get a lot of influencers who seem impartial and who say, I've got this great investment. A lot of these YouTubers and influencers are actually paid by these silver miners, gold miners who are actually faltering and whose profitability, that every metric you could measure, is terrible. So once again, go do your own research. I would only recommend for investing in silver miners if you are willing to put in the time and really understand what you're doing. And lastly, watch that gold to silver ratio. That is a really simple thing you can find with this quick Google search, and just watch it. Obviously, if you see it go down towards head more towards 1 to 15, it means that there's probably evidence of a supply crunch, that silver is becoming more fairly valued compared to gold.
Right. Just going back to number 2, stacking the physical. There are also services like Bullion Vault, or the online providers that actually store your physical gold or silver in their vaults in New York or in Switzerland or in different parts of the world.
One caveat that I would say with that is you'll have some options. So you can actually buy the specific physical, or you can opt for pool. Now, what pooled basically means is that although you have a claim to the physical, your silver is pooled with everyone else's. It's just in the same batch. So obviously in the event of supply squeeze and there's a run on the bank, everyone starts to demand the physical stuff. Obviously the question is are those firms that you trust to actually have your gold, do they have it? Sorry, gold and silver, do they actually have it, or are they actually going to just pay you out in the paper claim? So I would also, if you are going to opt for that, yeah, I would specifically don't buy pool. But once again, do your own research. Although I know quite a bit about this, I wouldn't define myself as an expert by any means. David, what are your thoughts? Let's round up, because this has been new to you as well. In terms of, I know you follow a lot of different investments, but obviously, what's your view? What has it changed your view? Would you consider buying some silver?
Well, as you know, I was definitely put off of gold and silver many years ago once I was introduced to Bitcoin, but you made a really compelling case about what silver has been doing very recently. And I did not know the majority of what you shared. It was a very surprising, and it's more immediate. It's not like I have to wait years to see this. This is unfolding day by day and week by week. And with the Fed potentially lowering rates, we're going to continue to see this spike in not only in just the price of gold and silver, but in the ratio between silver and gold, where it's out of balance right now. And it's going to revert, as it's done in history, it's going to revert to its kind of 1 to 15 ratio. And it's really, really important to watch. So I'll be honest, I'm going to be researching a bit more, and I'm going to be considering a very small percentage allocation towards silver.
Absolutely. I mean, as I said, I would firstly, that's great to hear. And I love the fact that you called out doing your own research. As I said, and I'll reiterate it one more time, go question everything. Question people like myself and David. Question any influencer you see, and just go search the facts and try and keep it, if you're new to it, keep it very simple. Keep it, how much is there? What's the demand? Is demand increasing or decreasing? What's the supply? Is supply increasing or decreasing? What's the inventory levels? Simple translation, how much silver do they actually have? Are these big entities holding that they can use if there is a supply, if there is a demand increase suddenly, that they can use to fulfill that demand? Is it running low? keep it really simple like that, and start with those facts and then expand onto other things, which is why I really like the gold to silver ratio, because I think it's a really nice one that you can see, okay, for the past how many thousands of years, gold historically has been priced at 15 to 1, meaning 15 ounces of silver to one ounce of gold. And now, as I said, we've seen it trade as high as 120. Right. So that's decreasing, but just keep your eyes on that. And as I said, although we are a Bitcoin-centric channel, we do like to discuss these things. Silver, for all of its disadvantages compared to Bitcoin, and we'll go into those in another video, has been a hard money. And if you gave me the choice of whether I would rather hold US dollars or Turkish lira or something like that, my preference would be to hold physical silver.
Right. Well, that's what I like about your perspective, Dom, is although we both are Bitcoin maximalists, you are introducing other opportunities. You know, this is very much aligned to the 1% principle, right? There are opportunities to make asymmetric returns with investments, but only Absolutely. Based on research. And that's what you're providing. You're providing really quite informative facts. They're not opinions, they're not speculations, they're facts about what the big players are doing. The banks, the governments, JP Morgan is shocking what they're doing in the background. And follow where the money's going. What are the big players doing? And why not take out positions based on your research, obviously, but why not take a 1% allocation towards these asymmetric bets?
That's it. If you've got something where you invest $100, your downside, yes, could potentially be $100. I don't think if you invest in silver, it's going to go to zero, to be honest. So I don't see your downside as being losing all of your money, like 100%. But your upside potential, from what we've seen with some of these estimates, I mean, could be 1.5, 2, 3, 4, 5, 10. I mean, some people predict that in the next 10 years, because of exactly reasons like this, and because of the debasement problem that JP Morgan have alluded to and that Bitcoin has been going on for years, you could see silver at over $500. Well, that's like 8x over a 10-year period.
Yeah.
So yeah, that small 1% allocation could turn into 5, 10% of your portfolio. Now that is really meaningful. And your risk, I believe, could be 50, 60, 70% downside. So you're risking $70, but the upside potential is 1,000, 500 to 1,000. It's all about those asymmetric bets.
And in comparison to gold, because I was also considering, this is when we saw the price of gold reach all-time highs very recently. I was thinking, well, gold would be kind of an option, but considering silver has appreciated over 100% in the past year, almost 100%, and gold is between 50 and 60% of a price appreciation. There's greater opportunity with silver.
There is. I mean, as I said, the last comment I will make on that is one that we kind of touched on in the video, is David obviously mentioned about the industrial use and the demand for it, and obviously the point of gold. Now, obviously, we've got store of value. As I said, gold is 90% store of value, meaning it's not used as much as people think. The main use is jewelry, and that's only because humans have decided that it's they like wearing it. It looks good and it's valuable. The other 10% is industrial, but with silver, the vast majority is industrial, meaning if that demand keeps increasing because it's needed in all these things, then the price, and there's no more supply, the price has got to go up. It's just simple mathematics.
Yeah.
Anyway, that's where we will leave it for today, guys. I know that for your Bitcoiners out there, you may have been hoping for something different. You may be a bit disgruntled that we're talking about something different. We just like to make sure that even though we are Bitcoin maxis, we do look at the facts on things. So do not forget that when it comes to silver, most will miss it, most will mock it, and most will wait until it's too late. But the 1%, they it with conviction.
Be a 1%er.
Thanks, guys.
Great. Goodbye.